You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, that's better. All right, everybody. That music means it is Education Wednesday once again. Time once again for a little program we like to call around these parts Options Bootcamp, your premier options education program. Coming up on, what are we now? Episode 204, coming off the heels of the big 200th episode, over a decade now of Options Bootcamp in your ear holes. Glad to see so many of you folks enjoying it. Of course, if you like what you hear, keep rating and reviewing. Really, the new folks discovering the show day after day, week after week, month after month are what keep things rolling over there. The numbers in for August, the hottest month in the 15-plus year history of the network, which July was the month before that, which June was the month before that. So every month this year pretty much been a new record. That's all thanks to you folks out there. Of course, if you like what you hear and want to go above and beyond, you want to join us perhaps live. We are trying to live stream this one as we speak for all you pro folks out there, as well as, of course, you want to join us for exclusive shows like our pro Q&As every Tuesday, as well as Options Oddities, where we dive into the week's worth of unusual activity, as well as do some fun trading for Options Oddities every Friday, as well as great giveaways. We're coming up for the September Pro Trading Crate and a whole bunch more. TheOptionsInsider.com/pro is the place to go. Or for you cool kids out there, /secret club. But don't tell anybody. It's just a secret. Between you and me. Speaking of you and me, it's not just myself here in the studio. Actually, if I sound a little bit different, it's because I'm not in the studio today, listeners. I am down the street. I am studio adjacent. Cboe missed me so much, they moved their new headquarters right down the street from the Options Insider studios. And I am pleased to be joined once again in person for the second time after like years of not seeing each other. Second time in the span of a couple of months by the black-hatted one himself, Mr. Dan Passarelli. Mr. P, well, welcome back to your own event, sir.
Good to be back, and good to be here back in person.
Yes, it is good indeed. Give me another test one to get into that market.
Test.
That's better. There we go. Now the folks can hear you, sir. See,
need to be closer.
I know you have no experience on stage with a microphone, so this is all new to you. But yes, eat that microphone up. It's your friend. All right. And speaking of our reviews, this week's 5-star review comes from Jovi. I think that's how that's pronounced. They just write in saying, "Thanks for teaching me so much. I'm learning and actually laughing a bit. Mostly at Dan." I like this person. Best options show around. You know what, Jovi? You get 5 stars from me for that review. Throwing some shade at Dan. That's good. We should end the show right there. Bam. Thank you, Jovi. You win. You get a prize out there. So, Dan, a lot of good stuff out there. As we keep on rolling into our first segment, it's time for a little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, you're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, pull in, prepare to learn.
All right, everybody, welcome to the basic training segment. That music means it is time to break down a basic options trade or idea or concept and dive into it in a little bit more detail. And Dan, we're going to dive into a topic we were talking about on the show last week based on a lot of listener feedback In fact, that's our question of the week this week. It was inspired by our show last week. We asked our folks out there, inspired by our recent options boot camp, it seems like we might be in the middle of a bit of an iron condor renaissance. This strategy was super hot about a decade ago, but seems to have cooled off in recent years. Is this strategy making comeback? We gave you guys 4 choices. Yes, I am trading iron condor. So yes, we are in the middle of an iron condor renaissance. Or no, I prefer iron butterflies. Or no, I prefer traditional butterflies. Or they never went away. Dan, what is your vote? And what do you think our audience is voting for, sir?
I think that, yes, I'm trading iron condors is likely to be the winner.
Is that your vote as well? Are you a big iron condor man? Are you more of a fly guy? Or you think they never went away? They've been hot all this time?
I think we're in a, what did you call it?
Iron condor renaissance.
Iron condor renaissance, yes.
Okay.
I think that's what it is, yes.
What do you guys think? Are you guys iron condor traders here? Raise your hand if you trade iron condor. I heard you guys talk, all of you. So you guys would vote, I guess, that we are in the middle of an iron condor renaissance. Yes, okay. It was interesting because when we first started the Options Insider, which was over 15 years ago, iron condors were the hottest thing on the planet. It seemed like everybody out there who had a guru educational service or a newsletter, whatever it was, they were all based around iron condors. I don't know why they got so hot at that time frame, but they did. And then it seems like they kind of fell off a cliff. And then for the better part, I'd say of the last decade or so, we would talk about them every now and then, but they weren't really super hot. In fact, I went looking through the archives of this show. We have 200 plus episodes, over a decade worth of shows, to see if we have anything remotely focused around iron. We touched on them a few times, but we've never had a whole show devoted to iron, which that in and of itself, I guess, speaks to, we never really had a demand, perhaps until now. We needed an iron condor renaissance to bring us in.
204 tries.
Yes, 204 tries. All the fans out there of iron condors, and now they finally get an episode. Dan, so what do you think? Think we should do a little bit of a dive, a refresher here on all things iron condor?
Yeah, we have to answer the public, Mark.
We have to speak to them. Oh, by the way, I should reveal the results. I teased you guys with this poll. The actual results right now, as we're talking about it, 59% of people saying, yes, we are in the middle of an iron condor renaissance, and they are trading iron condors. 24% get in the camp. I kind of fall into more. No, I prefer butterflies. I think I'm more of a fly guy. 12% say they never went away. So 12%, they've been slinging iron condors this whole time. They never stopped. And 6%, I also like these guys too. These are the hardcore guys. They know I prefer iron flies. We used to have a cohort on our Volatility View show back in the day. And he used to always say that an iron condor is an iron butterfly for cowards, is what it is. And I always love that saying. That just cracked me up. It's like, if you're going to do it, go big or go home, right? None of this wiggle room cushion here.
No, the never went away guys, they're still wearing Sansbelt pants, though.
They are. Yeah. They're waiting for everything to come back around, And everything old is new again for that group. So, yes. So there you go, listeners. That is at Options over there on Twitter. You got about a couple of days left. It goes to the end of the week if you want to make your voice heard over there on that one, listeners. Let's get into it a little bit, Dan. Let's start, the basic of an iron condor. There's 2 different ways you could view an iron condor. Do you view it more as a put spread and a call spread, or do you view it as a strangle and another strangle? How do you view, when you approach an iron condor, how do you view it?
I would say yes.
That is no fun.
But, mostly I like to think of it as two credit spreads. And I think it's important to think of them that way because, well, I mean, that's what they are. As long as it doesn't go through the short strike, through the short call strike, you're good, or through the short put strike, you're good. But the real advantage of it is that because it is 2 spreads, you're kind of, in one sense, double dipping. You're getting 2 credits instead of just 1.
So you're only looking at selling iron condors. You're not going to buy an iron condor.
Typically, I find that, I would rather buy a strangle outright than limit my profit on basically a strangle and selling another strangle.
It's for a strangle when you're not really that convinced, right?
You're
not really that convinced. You're like, maybe it might move, but just in case. All right, so what the heck are we talking about here, listeners? What is an iron condor? Like I said, you can view it a couple of different ways. Dan likes to view it as 2 out-of-the-money spreads, a put spread and a call spread. You can also view it as essentially a strangle and then another strangle against it. So let's walk you through a pretty basic example. Everyone's favorite, XYZ. We've all made and lost fortunes in XYZ over the years. Right now, XYZ, for our example, it's hanging out at $50. And so we're going to go to the long side. We're going to cause problems for Dan and say we're going to go long iron condor today because our people like to buy stuff too. So you think XYZ might be moving a little bit around the 50 handle, but A, you're not sure where it's going to go. And B, you're not maybe uber convinced that it's going to happen. So you need maybe a little bit of wiggle room and a little bit of protection so you're not spending all the money out there. And that's one of the scenarios where an iron condor might come into play. So what is it? We start off, there's two parts. First off, we're going to buy the 45-40 put spread. So in our example, XYZ is hanging out at 50. You're going to buy a $5 out of the money put spread. In our example, that costs $1. So you're spending $1. And normally, if you just bought that put spread, you obviously want the stock to get down below 44 for you to make money on that spread. But in this case, the iron condor has two parts. And the other part is an out of the money call spread as well. So in our example, we're also going to buy the 55-60 call spread, another $5 out of the money spread. And in our example, to keep things simple, that also costs $1. So you're spending the same amount for both. You know, if you've been trading options for a while, it's probably not going to happen that way. The calls are going to be cheaper. The puts are going to be more expensive. But to keep things straightforward, we're going to have a nice flat skew here in XYZ today. So it costs you $2 net for this iron condor. So now what have you done? You've done two separate things. You bought a call spread, a 55-60 call spread, so you want the underlying to rally. Obviously, if you just bought that for $1, you'd have to get to $56 for break even. But remember, you bought two spreads now. You spent $2. So for either of these spreads, if the underlying moves in either direction, you needed to move a little bit extra. You needed to move to $57 to the upside or $43 for either of these trades to break even and start making money. And I said you can look at it a couple of different ways. You can look at it as those two spreads, or you can look at it as the way I tend to think about it too. I think maybe it's easier for people to approach sometimes, is you're going out and you're buying, in our example, a strangle. You're buying the 45-55 strangle on XYZ. And you know, when you're buying a strangle, you want it to move, right? You want this thing to take off. You want it to move. You don't care which direction, as long as it goes somewhere. It's like the bouncer at the bar at the end of the night. You can go somewhere, but yes, it can't stay here. You have to go somewhere. And so that's what you want the underlying to do here. But in this case, maybe you're not entirely convinced, or maybe you just don't want to shell out that much premium for it. So you're going to sell the 40-60 strangle against it as a way to recoup some of your costs. So that's your basic structure. That's your basic approach for an iron condor. Like I said, this strategy, super hot back in the day, kind of fell by the wayside. Now it seems like we're having a bit of an iron condor renaissance. Dan, when you're looking at an iron condor, obviously you look at them from the short side. So walk us through that a little bit. When do you decide, man, I might want to use an iron condor here as opposed to a fly or a straight strangle or a vertical or something else?
Yeah. Like I said, I tend to typically think of iron condors as two credit spreads. But I mean, really thinking about it as a short strangle with protection, I think is really, really useful. Personally, I don't like selling naked short strangles. I think there's just too much risk. 9 times out of 10, I mean, more realistically, 98 times out of 100, you're going to be fine selling a strangle. It's those other 2 times that are the problem. So yeah, I'm basically, whenever I'm looking for a stock that's channeling, where there's both support and resistance, preferably horizontal support and resistance, that's when I start looking for considering an iron condor. And I kind of look at it as, okay, here's where I can do the short strike for the put down at or below support. Here's where I can do the short call strike at or above resistance, and then just buy some strikes outside of that. So yeah, it's kind of interesting going back to this. It's kind of interesting going back to this idea of, is it two strangles or is it 2 credit spreads? And I guess you really kind of have to think about it both ways.
I think because if you think about it as a strangle, obviously you're right. Oh, I need to cover this risk, especially if you're selling it. And obviously, listeners, we could flip our example around and go to the short side to make the black-hatted one, Mr. Pastor, make him happy. All he does is sell premium all day. And so in this case, obviously, you would sell that spread. You would sell the 45-50 put spread for $1. You would sell the 55-60 call spread for $1. So you would collect $2. So that example, as long as you stay below 57 to the upside or 43 to the downside, you will be making some money on that spread. So you could see the use case for why you might want to employ it. You can also see why, if you're not entirely convicted on a particular strategy or a particular approach, why the iron condor has gained favor with a lot of that crowd. That's why also people have jokingly referred to it as the iron butterfly for cowards, because the iron butterfly usually involves a long or short at the money straddle. So you're right in the fire. There's no playing around. You're in it with an iron butterfly, and then you're buying or selling an out of the money strangle against it to protect yourself. So the iron fly, you're right in it. There's no messing around. An iron condor, as you can see, we gave ourselves $5 worth of cushion around the at the money. So it's a little bit more wiggle room. It's a little bit more, I would say, newcomer friendly for that reason. You can still get run over, obviously, but you got a little bit more wiggle room, a little bit more room to run. So in case something happens, or in case of Dan, if you're selling these and something happens unanticipated, you have a little bit more cushion built in. Now, you guys say you trade iron condors here. I'm curious, why do you trade? What's a use case for you guys when you trade iron condors? When you're coming in, you're looking at a strategy, looking at a setup, or maybe John, for you, you said you like iron condors. What's a setup where you look at it and say, I really would like a long or short iron condor here?
If I see horizontal support resistance, I always kind of look at a calendar first. And if a calendar doesn't work out just because IB skew or lack of something, then I look for an iron condor. I'm in the camp that I look at as more two credit spreads for myself, betting on those levels of hold. So I'm giving myself a high probability position. The risk reward's not so well, but I do like the wiggle room, like you said, Mark. So.
And you guys are both short iron con, never buying an iron con. No premium buy-in here.
No, not in that case. I will buy a straddle or a strangle, because that, like, those are volatility trades. And if you're buying an iron condor, you're buying a volatility trade too, but then you're truncating it. You're saying, I want volatility, but I don't think it's going to be that volatile. To me, it's just, I have a hard time making.
I mean, I think it's great to be able to have an opportunity to extract funding from the market, being delta neutral, without having to have the directionality to it.
Yeah, you can construct condors, obviously, so they don't have a much or any delta to them. And you could hedge it away, too, if you were really... Do you guys do a lot of delta neutral hedging with your portfolio? That's kind of challenging, I know, for a lot of retail to do, but you do? With them?
No.
Oh, okay.
It is challenging.
Yeah, it is very challenging, yeah. Yes. Because otherwise, that's something obviously we used to do as market makers a lot, but we had very different... account setups, very different margin treatment. We could sling, hundreds of thousands of shares and it wasn't a big deal. For retail, that gets expensive, that gets laborious. You're tying up a lot of capital to do it. But you're right, you can construct them so that there is not a lot of delta in either direction. Dan, any other thoughts here on Iron Condor for our little kind of Iron Condor teaser / refresher, I guess, / introducer? We've never really done them on the show before.
One thing I do want to point out is I almost don't look at iron, again, talking from the short side, I don't really look at iron condors and iron butterflies as even potential substitutes. I feel like they're very different. Iron butterflies are just, short butterflies when you're short the middle and long the wings. They work really, really well with maybe like a week or less until expiration. That's when the theta really comes into play. Whereas iron condors, I'm okay putting those on up to 3 weeks out. You get a steadier amount of time decay with iron condors as opposed to butterflies, where it's just like it sits and doesn't change price for 2 weeks. And then finally the last week, then you start reaping what you sowed.
That could be a good follow-up question for this down the road, too, is that people, do they prefer to buy their iron condors or do they prefer to sell them? So it sounds like over half of the audience is trading iron condors. They're into them. So I guess maybe we need to have a follow-up question. What do you think, Dan?
I think that sounds like a plan.
And speaking of following up, let's do so, listeners. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Ooh, that's super loud. There we go. Trying to give the live folks a taste of the music behind the scenes here, listeners. All right, welcome to the mail call, the portion of the show where you folks take the reins. We answer all of your questions and comments. If you guys around the table, if you have questions, feel free to raise your hand and we'll get to you folks. We'll start off here. We already talked about this week's poll. Let's pay off last week's question of the week as well, Dan. We said we've seen an explosion of new options traders in recent years. So that brings us back to the age-old question. When did you guys start trading options? And we gave you guys 4 choices. Obviously, we couldn't have infinite choices. Some people wanted a super old school option. We didn't have room for that, listeners. So he's had just started this year, so you're new to 2022, or you started in the pandemic rush, so sometime in 2020 or 2021, or you're in that decade post-Great Financial Crisis, 2009 to 2019, or you're quote-unquote, for the purposes of this poll, old school, pre-2009, even though I think Dan and I pshaw at that. And we wanted to have a super old school. No room for that. And Dan, 38.5% of our audience said they came in that post-Great Financial Crisis period, 2009 to 2019. It makes sense. It's the largest data set there. But also, interestingly enough, one of the reasons we wanted to separate out the more recent years is because we knew there were a lot of people coming into the market and coming into the show recently. And we actually had a tie. Exactly a tie, which is very strange. 28.8% for the pandemic rush period of 2020 to 2021, and also 28.8% for old school. So we have as many newbies coming in as we have old school hardcores in there. And then 3.8%, only 3.8% for just started this year. I thought that number would be higher, given the numbers and what we're seeing out there. Maybe some folks are embarrassed to put that. I don't know. But that's the reason we broke that out and didn't have a super old school. So I kind of assumed, we did this poll before. I know fully a third of the audience, I think I said, has started in the last 6 months or so. So this now, close to a third of our audience has started since the start of the pandemic, which also does jive with the numbers we're seeing out there in the broad industry, but still intriguing stuff out there.
What about our mastermind? When did you guys trading? A year ago.
1 year. Okay. So you'd be,
there we go.
You'd be close to old school in our pool.
Yeah.
Our pool.
Yeah.
I started about 3 years ago when I met you at a trade show.
Yeah. And you've been forever.
Yeah. Started a long time ago.
What were you trading before Dan lured you to the dark side of options?
Oh, that was a very difficult time period.
Oh, yeah. Futures.
I was in straight equities.
Oh, equities. He said, Dan's like, I got this cool thing called options. Come here. You had a trench coat. He said, come here, kid. First taste is free.
Hey, come back here.
See what you've done to the poor man. What you've done, introducing him to these options things. Now let's go out here to, I like this handle, Retro Tim. Maybe he's an 80s guy. Maybe even, who knows? Maybe he's definitely old school, whatever he is. He says, how far out, this is what we were just talking about here. How far out in time do you guys typically go when trading butterflies? I've seen everything from expiration day all the way out a year or more. It seems like closer to expiration seems to be the way to go rather than longer term, but I'd like to know what the pros have to say. We were just discussing this, just you and I, Dan. Obviously, I was just talking about this on a show recently as well. This is kind of a frequent topic because he's right. You know, the most common use case for butterflies is what you just said, right? Is that week heading into expiration, very near data, because you want that stuff to start collapsing. You want the vol to come out. You want the theta to come out. You want to capture the distance for that spread. But interestingly enough, I have seen a lot of people trying to come out and starting to argue to me and trying to make the use case for much longer term butterflies, like beyond 6 months, even into the leaps with a fly. And I always thought that was not really the designed use case for a fly. I mean, to me, if you're going to do that, you might get a decent move. You might capture a lot. I think you're also going to be very unhappy because let's say you do that in some crappy stock. You go out with a leap, you buy a long-term fly on it, and it explodes to the upside. You'll be happy. You'll make money, but you're not going to capture anywhere near what that fly is worth. You're going to have to sit there and wait for a lot of time to come out before you really see that spread start to widen out. So I've never been sold on the use case for long-term flies. Maybe you can sell me today, Dan. Sell me on long-term flies if you so desire.
I cannot. With long-term flies, you have all the risk and none of the profit. You know, the theta is always very, very small, and the risk is there. Like even if you do really, really wide wings, the break evens are really far away. If it's a year long, I mean, anything can happen during that period, and it's just you get totally minuscule theta, which is how you make your money on it. And the risk just sits there, just waiting to come and bite you in the behind.
Yeah, that's been the argument they make, is they try to make them really wide. Because obviously a tight long-term fly is meaningless. You might as well not even do it. But try to make them really wide. And if you're lucky, maybe you can get some decent, let's say, call skew. You can sell to the upside, and maybe you get a decent range you could trade for. You a long-term fly guy, John?
I like using them directional, a little longer term.
Do you?
I make them a really low risk with basically a delta trade, because theta is certainly not going to come into the picture.
No,
but
yeah.
I try to do like 10%. If the fly costs me 20 cents, at least like get like a 2 or 3 delta and make it a low risk, high reward trade.
And how far out would you normally go with that?
It's like a month or more.
Oh, a month. So you're not talking a year.
Yeah, no,
okay. A month is certainly, I think that's totally reasonable for a fly. Yeah. I thought you were talking like a year. No. I'm willing to be entertained the option. I've just never seen it really work. Or I've had so many people write to us, and even when you're going out a month, right? They go out and they say, I put on a fly and whatever it could be, VIX or some crazy name or whatever it is. And they got this huge pop. Like that happens with VIX a lot because VIX tends to whip around, right? I bought call fly and VIX, the thing shot up. And then I looked at my fly and it was up like 8 cents. Like what happened? I did the right thing. And I'd say, well, how far out did you go with your fly? And I went out a month and the thing happened the day after you put it on, right? And I always tell them, yeah, that's the challenge of flies, right? You need to have that exact movement you want happen, and it has to happen at the exact right time. Mm-hmm. And so the fly, if you put it on, it's like going to Vegas and you have like a week-long trip and you win a ton of money on your first hand. The first time you see you're like, what am I going to do for the rest of the week? You can't just sit there and not play, so you have to play. And so you have to wait. And so that's where people get really frustrated with flies. So that's the danger. Who wrote this in Retro Tim? I'm curious, you guys trade flies at all here? You got any butterfly? You're all iron condor guys. Okay, so interesting. You guys like any long-term iron condors by any chance? Or no? No love for those? No. All short-term? Okay. I'm trying to get you some love here, Retro Tim. Unfortunately, there is no love for you here. But it was a good question, though. I think we can maybe almost do another episode about that down the road, about time frames for constructing butterfly, because it does seem like there is a lot of people out there. Someone out there is hawking 0 days to expiration day flies. So people have been hitting me up about this lately a lot in our pro. Like, hey, aren't my flies supposed to be extreme, like same day as expiration? I was like, why are you doing that? Yeah, you kind of the horse is already out of the barn by that point, right? I mean, like 90% of the move you want to get with that fly should have already happened by that point. So that seems to be, especially for newcomers who don't really get it, that's a very risky. Anything expiration day is risky if you don't know what you're doing. But putting on a fly with expiration day, that just seems to me to be a road to ruin or accidental riches, maybe if you get lucky. But it just seems to be a very difficult way to go. So I think that 1 week, 2 week, sometime within a month time frame is a good approachable distance for people to start. It's pretty cheap. I'm assuming you're going to buy these things, but maybe if you want to sell them, you can go the other way. But do you sell flies or buy flies?
Yeah, strictly selling. Again, why truncate my risk?
I call you the black-hatted one for a reason, sir. You're just selling premium. Yeah. I'll sell the premium and live the dream. That's your mantra at MTM, right? Here's an interesting and or a weird question. This comes from Alan. Alan says, what, if anything, would you say is wrong with the options market right now?
Well,
that could be a whole episode in and of itself as well, I suppose.
My straddle didn't work out.
The Fed didn't. Hey, really quickly, if you want to touch on that really quickly, because we're doing this live right after the Fed has announced. If you want to walk really quickly people through what you're looking at with the Fed and maybe some thoughts on the market impact or lack thereof and how you can approach that with options. Go ahead.
Mm-hmm. Yeah. Okay. Yeah. I just put out a video to our group. Every day I do a video and it goes on our blog. So it's kind of like a vlog, I guess. And I talked about this, and there's a couple of ways to prioritize your straddles, right? As far as what you analyze first and what's more important. And to me, the most important thing with the straddle is, it's kind of just the opposite of what we were just talking about. It's kind of, okay, look, if I'm going to put this on for a short period of time, first of all, I like to buy a little bit of extra time. But then I say, where are the at expiration break evens, and how long ago was it on the chart? How many, 1 day candles ago was it since we've been through one of those break evens? So that part is a very, very simplistic approach. I'll also do, of course, the Greeks, and I'll look at the theta of it and see how many days I have that I have in order to make some profit. And I set a time stop on them. But my trade today was exactly what I described at the beginning of this conversation. I said, okay, we have the Fed announcement coming out. The implied volatility is really high. Do I think I can buy this straddle that expires tomorrow? And it was $7.60. And basically the bet was, do we move more than $7.60 tomorrow? And I bet that it was possible we could. And of course I did it very, very small, knowing full well I had to manage my risk. And I kind of had my finger on the button, and I waited until the announcement came out, and it hit right at 75 basis points. And I waited. I wasn't sure what was going to happen there. but it just wasn't moving very fast. And so I got out, very, very disciplined risk management, got out of the trade, and I took that chance. And if it would have paid off, I would have stood to make a lot more than I ended up losing.
Are we still hanging out unched or close to it right now?
I mean, now we're up about $4 in SPY.
So a little bit of action, a little bit of action.
I know.
A little bit of action out there. See the cost we pay for these shows. I'm missing trades all the time because of these shows.
We could have gamma scalped these straddles. That would have been nice.
And Alan, I don't mean to sidestep your question now. Maybe we'll get to it on a future show, because that's a more deep topic. What is wrong with the options market? Go ahead. You go. Go ahead, Jeff.
I think ridiculously wide bid-ask spread is what's wrong with the option market for retail traders.
There still are a lot of those. I mean, it depends. I know whenever I go to the OIC conference, Henry Schwartz always does his state of the industry. And one of the things he always talks about, which is interesting, is the degree of fragmentation. Like, what percent of names do half of the business, right? And for a long time, it was trending in the wrong direction. It was Apple and a handful of others, Tesla. You throw in like the top 10 or 20 names, they did more than half of the paper by a huge chunk. In the pandemic, that has started to move back a little bit. Everyone was piling into the meme names, so it's getting a little better, but you're right. Look at it. I mean, look how many, or I should say how few liquidity providers there are now, right? Like, all of us used to do that as a business. We're not doing it. You got your Citadels and your Susquehannas and a few others still doing it. And they obviously have deep pockets, but it's hard for them to provide liquidity for everything under the sun. Sometimes when we're doing our unusual activity show, we'll look at a print, and the market they disseminated was no bid at $5.
Yeah.
And they traded it for like $3.65. And I was like, what? No bid at $5? How can you imagine being down there back in the day and the Goldman broker walks into your pit? What's the market is called? No bid at $5. They would literally punch you in the face.
Yeah.
And they would probably be right to do so. Mm-hmm. So that's the kind of, so in some of these, let's say, less liquid names, you're right. The spreads are still, like all these trades we're talking about today, right? Iron condors, flies, these are all multi-leg strategies. You're going to get run over with slippage on this stuff just from the commissions. So, or just from these spreads, I should say. So yeah, it is challenging. That's why for some of these strategies, maybe we should make that caveat. Some of these strategies, tread only in like an Apple and a Facebook and a Google and a Tesla, and maybe not so much in your no bid at $5 names, because it's going to be hard to do a 3 or 4 legged spread and not get killed on that. That is a good point, though. Definitely the spreads certainly could improve, and certainly from no bid at $5. That one I couldn't believe it when I saw it out there. You guys have any questions in your live folks? I know you had Iron Condors. No questions percolating up. You got these guys all full of Manny's again. They're all tired from lunch.
We had barbecue this time.
Oh yeah, barbecue. Where'd you go this time?
What is it? Green
Street Meats. That place is good. Yes, that place is good. Got some good. This Fulton Market area here. It's the hot area these days. You're coming into the hot zone here. Yeah. All right, let's go here to this question from Madiva, or maybe Madiva. He or she wants to know: has Mark or Dan jumped into crypto options yet? What do they think of these markets versus regular equity options markets? Well, Madiva, we have a whole show for that called the Crypto Rundown. It airs right after the option block. So if you subscribe to this on the full network, you're already getting that. So you could hear deep dives into all things Bitcoin options there, but also ETH. And also we've added Solana recently. So we have 3 big ones. Most of that stuff is still going up on Deribit, which is still primarily an overseas venue. When you're talking, I'm assuming you're coming from the U.S. Most of our audience is. Talking for a U.S. crypto options viability, there's not that many vehicles still. There's obviously the stuff that goes up on CME. They have some big stuff. They have the 5X Bitcoin. They have the 50 ETH. Those are pretty big. They just launched micros on both of those, and futures and options. Liquidity is still not there on the options, but it's starting to get there. So that is an option if you're comfortable doing futures and futures options. And then always there's Bito. Bito is kind of the one I think a lot of our people have gravitated to. If you want to focus on Bitcoin, it does decent ADV, somewhere in the neighborhood of 60,000 contracts the last time I checked out there. The markets are pretty liquid. If you want to go out there to sell puts to get long or buy calls or do anything you want to do out there, Bito is actually decently liquid, got a decent amount of vol. And for tracking purposes, I was initially pretty dismissive of it. I thought it was going to get run over by roll yield and everything else. Mm-hmm. It seemed like the last time we ran the numbers on it, which was a few months ago, it was pretty close to spot bid. It was like 1.5% away. So it really hadn't suffered that much compared to all the horror stories you were hearing when it came out. This thing's going to get destroyed by position limits and roll yield. So I think Bito is the best experience I've had. And that's the best one thing for a lot of you because the spreads are decent. Getting back to what we were talking about with spreads. The spreads are pretty tight, and you can get some trades done, and it's a great approximation for crypto in a securities account while you're maybe waiting for Deribit or something else to get approved over here. Dan, what are your thoughts?
Well, I have not really dabbled in crypto options, just straight crypto. But one really important point, and I believe I've talked about this on this show at least once. To me, the most important thing about crypto options is you should only trade them if they are cleared, if they're underwritten by a clearing firm. Otherwise, you're just crazy. The clearing firm can't be the broker. It can't
Dan's
be the trading
clearing
platform.
firm. Yes.
Yeah. Because that firm, somebody hacks in there and the firm doesn't have any cash. And, the person who sold you that straddle that you made $100,000 on just decides to say, oh, no, sorry, I don't have the money. You're just host, that would be just like driving a car without insurance and not having health insurance. It'd be scary, crazy.
Yeah, Dan's right. Counterparty risk, a huge deal in the crypto space. Obviously, if you have a huge winner, you want the other guy to be there so you can collect. And it's not often is that the case where they are there. So if you have cleared contracts, there's no counterparty risk. The other side will be there, which is another reason why maybe BITO is favorable right now. It's cleared by OCC. So at the very least, questions about crypto underlying the side, at the very least, the counterparty for that trade will be there when it's time for you to cash in. Let's get out of here on this one, Dan, this week. Unless you guys, one last time, going around the horn. Anyone feeling brave? We're too intimidating for them,
No.
Dan.
So what would be a great way to get a watch list for stocks that would be potential ICs?
What would be a great way to get a watch list for stock?
Like a scan.
For potential iron condors.
Oh, for Iron Condor. Oh, I see what you're saying. Oh,
yeah.
Well, I guess we need to resurrect some of those old Iron Condor services that were all the rage like 15 years ago. There were a lot of people out there back in the day who were hawking this name is perfect for an Iron Condor. This is the perfect setup, and this is how you should do it. Maybe if there's demand, maybe we can do a future episode on maybe the correct approach to an Iron Condor, when you should set it up, when not. I think we kind of gave some kind of general rules of thumb here. I guess I'm not a huge Iron Condor guy, so off the top of my head, I don't have any list, but maybe that could be. I don't know of any Iron Condors. Do you guys talk about a lot of Iron Condors? Do you over there at MTM? I can't think of any. They used to be like Condor options and a bunch of things. There were a dime a dozen, and now most of them I think have gone the way of the dodo. So maybe that should tell you something as well about condors in the long term. I don't know.
John talks about iron condors in his daily group coaching class.
Yeah. That's kind of my go-to strategy the last couple of months.
Yeah. Oh, yeah. So, yeah.
Volatility high and a lot of craziness and just playing between support and resistance levels.
Yeah, off the top of my head, I'm hard-pressed to think of another Condor-specific service that is out there. I mean, that's, again, maybe a telling sign of how things have gone in the market. Because, people touch on them every now and then, but I can't think of anyone who says, hey, here's a great list of names that are good setups for Iron Condor. Maybe that's an opening. Maybe someone needs to revisit that again. I don't know. But intriguing stuff. We'll get out of here on this one here, Dan. Let's this is a great handle. EL003TH.
I don't know what that is.
That's a memorable handle out there. He or she says, it seems like hedging with puts in SPY is extremely expensive. Yes. Welcome to the club.
Yeah.
Should I even bother? Are there ways to reduce that cost with, quote, special trick? Oh, special tricks. You want special tricks, Dan? That I would say, listen to the first 200 plus episodes. We've devoted a lot of time in the last decade plus to ways to quote unquote pay for your put. In fact, there's a substantial percentage of the options industry, I would say, Dan, that is day-to-day focused. Their entire life is paying for puts. That's all they want to do. Whether it's selling calls, it's selling puts against them, doing both. There's so many people out there, asset managers, money managers. They want to be long only. They want to have equity positions or whatever it is, and they want to have protection, and they spend their entire days looking to sell premium against it. So there is a substantial portion of the industry here, EL003TH, that is looking to do exactly what you're talking about on a daily basis. So I would say, yes, first, definitely, check out our archives. We've talked about collars. We've talked about put spreads with collars. We talked about combining those. Those are all very great ways to get yourself started. In a general ballpark rule of thumb, Dan, and maybe you have some thoughts on this as well. Most of the data I've seen, in a calm, tranquil, normal S&P market throughout the year, if you go out and you buy, let's say, a month or a couple months out, 5% out of the money puts in S&P, and you keep rolling them, let's say every couple of months throughout the year, it's going to cost you somewhere in the ballpark of 8%. That seems to be the number a lot of people have settled around. Obviously, different years are going to have different amounts depending on how the put skew and everything else like that. But of course, that should leap off immediately. Your average S&P return is what? Somewhere around 7%, right? So that immediately you're in the hole if you're just doing that. So you're right. They are expensive, and you do need some quote unquote special tricks. And luckily for you, we have talked about those.
Yeah. One of those special tricks is buy them when you can, not when you have to.
Yes.
Because, I mean, man, I've gone over this in videos and in some of our classes where you look at any like major move, like take the March pandemic move of 2020 and you look and the implied volatility is highest like 3 days before the market bottomed out. So what that means is people were buying puts all the way down, and they bought the most puts at almost the bottom. So buy them when you can, not when you have to is one. But then we can do things like collars and split time collars where we're selling a shorter term call and a longer term put and rolling that requires some management and such. But there's definitely some other tricks.
The other side of that, of course, is sell the put when you have a nice move, too. You get that nice pop. People always forget. They have the hedge, and they don't do anything with it, right? They bought this put. They did great timing. The market implodes. The put explodes. Hey, this is great. Yeah. And then they sit there and they watch the thing figure out. Yeah. And it's like, wait, you have that hedge. You need to monetize it. You need to use it. You can put that capital to work buying more on whatever you want to do with it. But we see that all the time on our unusual activity, too. People have a great trade, and they just do nothing with it. So if you do it as well, of course, make sure to have some sort of rule in place for when you're going to take it off and maybe use that to reposition with some more of whatever you're buying the puts on or whatever the case may be. But do something with it is the other side, definitely. Mm-hmm. But yes, luckily we have spent a decade plus, 200 plus episodes touching on this. So check this out. Also, if you're interested in this EL003TA, check out the Advisors Option Show as well. We talked a lot about that and the proper construction of puts and how to get out of them in a timely fashion there as well. Speaking of timely fashion, we have come to the end of our time here today, Mr. Dan. A fun time, good time seeing all your market taker mentees here in person. I like getting out of the studio a little bit. It's fun, breath of fresh air here in maybe not around you, but in general, walking here to the Cboe is kind of fun. And before we go, Dan, if folks are intrigued, maybe they want to join you for a future mastermind, or maybe they just want to check out what's cooking in the land of MTM. Where should they go? What should they do?
Sure. Make your way on over to markettaker.com and join free. Some of those videos, daily videos that I put out, will end up in your email inbox, and check them out. You can learn something and participate, and we'd love to help out any way we can.
There you go. Markettaker.com. 2 T's. Don't forget the second T for Theta over there, Market Taker. And of course, that's going to do it for us today, listeners. We'll have Brian coming at you a little bit later, live to tape with OPR. If you're not listening to that one, very much a sister show to this one. If you like educational content, Brian's got you. He's also got some actionable trading ideas and a lot of other fun over there on Options Playbook Radio. Back again tomorrow with the option block, as well as This Week in Futures Options. Friday, volatility views. And then, of course, for all you pro folks out there, back again for Options Oddities. And we come back next week all the way through to another Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.